No doubt, you have seen much volatility in the market for 2022. But how do you invest in a volatile market that's going down or sideways? In this episode, we walk you through different ideas, how to invest, how to keep it safe. And our goal is by the end of this video that you will have the understanding you need to have a secure peace of mind throughout retirement.
To learn more about how to secure your retirement and all the different elements you need to know, please subscribe to our channel and hit the bell so you'll be notified when we release episodes every Monday. We have helped hundreds of our clients gain clarity and get on the path to a great retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to our Secure Your Retirement podcast. We are going to be talking to you today about something that has been on your radar, your mind, your thought process all year long, and that is volatile markets, in particularly a market that's going down or sideways. And that's what we've had going on this entire year. And it really comes down to this particular scenario. You know, Merch and I, we work with individuals that are close to or already in retirement. So the closer you are to retirement, the more nervous a downside market affects us. When the market's going down, it creates more anxiety than if I were still working and funding my retirement plan. Or if I'm really close, even though I'm still funding, I go, man, I got to make it there. So these down markets can make it very, very, very difficult. It can create a lot of anxiety. It can keep a lot of us up all night. So how do we deal with it? What do we do with it? Well, Merce and I, that's what we talk about all the time. We talk about how to have what in all essence is called a sell-side discipline. And we're going to go into a little bit of that. But then what do you do if you're in an extended downside? You're in an extended downturn in the markets. One thing, and we'll recap this for you for markets that are down for just a little bit, and then they go back up really fast. We've had that happen a few times in the last decade. And then we've had these extended downturns, kind of like you might think of a 2000, 2001, 2002, or a 2008, which was an 18-month downturn from a top to a bottom. And here we sit in one now, and we'll recap that for you. What do you do in those compared to when you have the short downturn? So I thought what would be nice, we're going to talk about, by the way, how do we invest in a downturn market? We're going to go through that. We're going to give you some things of what we're doing. We're going to just open up and say, hey, here's what we're doing. Here's how we're doing this for our clients. But then I also want to give you some perspective. So I think what we'll do is I'll give you the real quick glimpse of a quick downturn. And it was one of the most recent, which is March 2020. March 2020, the market fell 34% from top to bottom for the year. But it then came roaring back. And by the end of the year, it was up 17%. Positive. So that was a very quick, fast falling market and a very fast recovery. So fast that many people said, the pandemic downturn wasn't even that bad. Pandemic was bad. Sitting at home for 2 years was bad, but the downturn in the market really wasn't that bad. It actually created a lot of opportunity. That's the way it felt. We almost forgot about the 34% drop. This is different, and it's not even a 34% drop. So Merce, can you kind of take us through 2022 as a comparative to a quick downturn, quick recovery?
Yeah, and that 2020 story, that was what is this thing called the pandemic? What's coronavirus? So it was a fire sale in the stock markets. That's how it dropped so quickly. And then the government had to step in and print some money and keep people on their feet. And that's where the recovery came back so quickly. Now here in 2022, we're dealing with some of the repercussions of that, which has been very focused around inflation and what the Fed is doing. This whole year has really been full of volatility, and it's been negative the entire year. I think the first trading day of 2022 was the only day that the markets went positive for this year, and then it's just been falling since. And somewhere in the middle of the year, around June, the indexes hit their lows. S&P 500 was down around 23.5% at its low, and then they rallied and recovered. And got to a point where they were down 10%, and everyone thought that the bottom was in. And now here we sit as of this recording. The markets have retested those lows and also past those lows, sitting at the S&P as of this recording is down a little bit over 24%. The NASDAQ's down around 30%, 31%. So, and also, it's not just the equity markets that have been affected. We've been saying this all year. The bond market has been in relatively in a worse scenario. The bond market has just been getting crumbled because of this rising interest rate environment that we're in. The AGG, the aggregate bond index, so kind of like the S&P 500 of the bond world, as of this recording, is down somewhere around 16%. And so the idea of using bonds to de-risk your portfolio and reduce volatility, to hedge yourself with bonds, has not worked at all this year in 2022. It's been a very choppy market, very volatile, and a lot of it again is because around the idea of combating inflation and the Fed saying that they're going to be very strong in that idea of we got to raise interest rates and people are going to suffer, but we got to get this under control sooner rather than later. And then on top of that, there's a war overseas in Ukraine that's been going a lot longer than I think people expected, and that's had issues on a very massive scale with oil and gas prices and everything like that. So the markets in general, from a U.S. perspective, but also just a global economic, has been really rattled this year. And so the question becomes, how do we do this? We're sitting 10 months into the year, and there hasn't been a positive piece of anything to work with. How do we navigate prolonged down market, or even a market that a lot of the term that's being phrased is that we're in a trading ban, or we're going sideways for a period of time until there's resolution? How do we navigate those types of markets?
Yeah, and I think from our perspective, just to kind of let you know, as from our perspective as individuals that are out looking for investments, we've not really had to deal with this market since 2008, this type of market. The other markets, if you take a 2015, a 2011, that had significant sell-offs in the August timeframe of the year, those 2 years, and then a March 2020 significant sell-off, very quick sell-off. You just move to the sidelines, you sit in a money market, you wait for a couple weeks at the most, and then you get right back in the markets, or you shift to bonds. Relatively easy type navigations. 2008, difficult period, but we had time there. We had an 18-month time horizon, and once it was kind of like, oh, this is going to be a longer term thing, we were able to figure out how to navigate that. What's different in this particular market that we didn't have in an 08 scenario is we are in a rising interest rate inflationary period, and in 2008 it was the exact opposite. Rates were being dropped, and we had deflation going on because the markets and the economy, and it was all crashing. It was the financial crisis. Right now, we're not in a financial crisis. We're just in an inflationary crisis. And so we're seeing pricing run up, completely different market. And so we have to look for ways to be able to deal with that. So right now, we are in all essence not just saying, let's just sit in a money market account that just cash is better than being invested. We've had to look for other ways to handle it. So I think what we could do at this point is we're just going to give you some examples. We're not going to give you ticker symbols and those kind of things for this type of an atmosphere, but we're going to give you high level. So there are two funds that right now we're sitting in that's earning right around that 2% mark. So Merce, can you just, first of all, let's just talk about those two funds and give, again, a very high level of what they look like.
Yeah, those are very secure funds that we are in, and basically they are government obligations and treasury obligations that are going to pay rates of return. So it's very similar to sitting in, say, a money market, but they're funds. They are actual mutual funds that we are in, and they're going to they pay a floating rate of return, some based on where the short-term treasuries are, because part of this is treasury obligations. And that floating rate is going to adjust every 7 days. Well, what we know right now is that interest rates are going up, and that is going to be reflected in that floating rate. So right now, the 7-day yield has been a little bit better than 2%. And the way that works is every, say, 15th of the month or every 10th of the month, depending on when they pay, based on how much you have in those funds, you're going to get that monthly dividend or that monthly interest payment that comes into the account, gets reinvested into that fund, and we're not subject to the volatility of the market. It's not correlated to the market at all. And in fact, the fund doesn't even move. It's $1 $1 is worth is one quantity basically. So the fund is not designed to have growth in it. It's just designed to protect your principal and then also provide some interest payments while you're in there.
Yeah. So now that's where the vast majority of the money has set. But now, again, as things are evolving, we're seeing a market that is prolonging in its volatility. We're seeing interest rates that are rising, and we're seeing inflation that is rising. So we've had to even expand further. And so we have, in addition, basically started to put a part of the portfolio into, in all essence, what would in the industry be called structured products. But they are backed by large banks, like the JP Morgan, for example. And the purpose of these is really to kind of say, hey, we're going to put together a fund that in that fund is going to pay a coupon or an interest, if you want to think about it. I'm just trying to use terms that you could visualize, based on an annualized rate. And we basically are able to go out. The more volatile the market is, the better these things are going to pay, because that's what's driving it. The interest rates going up, that's going to drive it. So again, think about an investment that's not correlated to the stock market, does well in rising interest rates, does well in high volatility. When we get into that environment, we can put together this particular offering, and we in all essence partner with those major banks. We can go with Citibank, JP Morgan. What was the other one?
Barclays is out there, Morgan Stanley.
Yeah.
There, all the major banks are out there that are available. So we get to go shopping, basically.
Yeah. So basically, we'll go out there. We put together these offerings. The one that we did in the last offering was paying a 9% coupon. In all essence, think 9% a year in its offering. The one that we have just bought, that's going to go into the portfolios here in a week or so, is 11%, right? 11.
Yep, a little bit better than 11.
11%. Now, you hear that and you're going to go, why don't you put everything in that type of a place? Well, because again, we don't want to go down that. We're risk managers. So we say, look, we don't want to do that. We're buying about 2% a year in the portfolio to a max of 24% in a year. Now, let me give you another caveat. This coupon rate is only guaranteed for us for 3 months. At the end of 3 months, it could go away. If the bank decides that, hey, they want to close it down, they can close it down. And now we've got to go out and put together another one, and it might not pay as good. But for those 3 months, we got an annualized monthly distribution of that 9 or 11%, whatever it is that we're getting for those particular deals. So it's a lot of work for us, but at the same token, it's what we need to do in this type of environment. So it works. It is something that is, if we get the markets balance out, start growing again, and get out of this volatility, those are very likely not going to be as attractive as they are today. So it's not something that we would go out and work to do in a rising market that's got low risk, low interest rates, or falling interest rates. We may not be able to get anywhere close to those rates, but it is something that we can utilize now, at least to get some return in the portfolio. Anything else on that, Merce, at all that I might have overlooked on those?
No, I think that's good.
Yeah. So I think high level is what we're looking for right now are things that are low risk, not correlated to the stock market, that do well in rising interest rate environments. That's really what we're looking for. All of those attributes. That is not something you go out and just do and buy one thing. This is something that you want to do in a diversified way. Now, I know we've talked about things that you may or may not have heard, but if you think, hey, I'd like to have a conversation around this, we'd be glad to hop on a phone call with you. You can just simply go to our website, go to the top right-hand corner, click on the schedule call button. You'll see our calendar come up. You can hop on a phone call. We'll talk to you. That's for 15 minutes, no obligation, complimentary. We're glad to talk to you about it. We are not telling you we have perfect systems. We're telling you we have really good approaches to how to deal with markets that give us problems. Whether that be a sell-side discipline or looking for alternatives to the current situation. We certainly do appreciate you spending a few minutes with us today to talk about what is a pretty good risk type year with the type of markets we're in. We will talk to you again next Monday. We hope this video has given you some confidence and clarity as you plan for a worry-free life in retirement. But what else do you need? We have created a complimentary video course called 3 Keys to Secure Your Retirement. This video walks you through step by step what you need to do to get ready for retirement. You can also check out our podcast called Secure Your Retirement. You can subscribe below.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.